Yes, Jerry Chikambi, good morning.
Good morning.
So, how is the time? How is the money? Are we united?
The time and the money, everything is going well so far. You see the weather,
You need
see
to
the
fix.
economy, how it's moving. So,
Brilliant. Can you turn off the bright light? I think it's the blue light.
put the light on. Like that?
Yeah.
Yes. Now give yourself headroom. Oh.
Now, give us some headroom. Just adjust the camera a bit so that we give some headroom.
Proper.
More down.
Give yourself space on top of the table.
Yeah. Perfect. Yes, please. Just like that. Are you in Windhoek?
Yeah, I'm in Windhoek.
Okay. We will start momentarily.
But you're not going
No problem. Just give me a signal.
Welcome back. It's Financial Matters. Since it's a Wednesday, we continue with such conversations. Now, rising interest rates are a key concern in today's economy as they increase the cost of borrowing. This can affect loans, mortgages, credit cards, and auto loans, leading to higher monthly payments. Now, to dive deeper into the topic of rising interest rates and loan management, we are joined virtually by financial advisor, that is Jerry Chikambi. Jerry, good morning. Thank you so much for making time to speak to us this morning.
Good morning.
Okay. Now, Jerry, let's talk about how do these rising interest rates affect existing loans, be it mortgages, credit cards, and auto loans, and possibly even student loans or even personal loans?
Yeah, as you know, the interest rate is something which only benefits the bank, because that's the general increase in the price of goods or any product. So when it's coming to loans, all the loans have been affected because it's only benefiting the financial provider, because they are the one who's going to get high interest at the end. So student loan, mortgage, and personal loans, credit card, auto loans, everything has been affected negatively. So it won't benefit anything to any client, but it only benefit to the provider, the financial provider.
Okay. Now, let's talk about perhaps maybe which of the loan products are mostly impacted by when we have interest rates. Now, we know that the bank, obviously the Bank of Namibia, had reduced the repo rate, so which means perhaps is this also a sign of relief in terms for those that might be having mortgage payments and other sort of payments?
Yes, as the Bank of Namibia have reduced, because remember when they reduce, meaning that the people outside are going to have a buying power. So you're going to have a buying power to buy properties. Even your interest rate, which you are going to pay now to the bank, is going to go low. So this is the best time now for people to buy property. Is the best time now to get the money which you invested into the bank. Because remember, when you invest money in the bank makes profit from your money. But this time, if you have a lot of money, so it's better for you to get that money, buy properties, or invest into something that people can also pay interest to you, because now the interest rate went down. So there's no much benefit to the lender. There's only benefit to the end user.
producer. Now, under these circumstances, in terms of rising interest rates, is refinancing mortgage advisable in a rising interest rate environment, or would one be waiting better maybe for a better option or when interest rates are down?
Yeah, now you see, refinancing is an option which is given to when you are facing challenges. So when you are facing challenges, for example, let's give an example. Let me give like COVID. During COVID time, it was always better to refinance. You must increase the long term because that time, remember, you have paid a certain amount of money. And when you paid a certain amount of money already, your amount which you are owing the loan, it went down. So once it reduces, so which means now you can put in a long term, so which means now your installment is going to be lower. But in terms of interest rate, it's good to prolong your mortgage. But remember, one thing you must remember is you prolong, meaning you're going to be in deficit, in financial problem for a long term. So refinancing is only good for temporary, because remember, you just need finance to extend in order to reduce your monthly installment, or for you to get a bit of change in order for you to pay for immediate expenses.
So financial discipline is a key word here. So in terms of, especially when it comes to mortgage payments specifically, what can then, in terms of when the interest rates, for instance, go up, how can you then manage this increase in mortgage payments? Do you make additional payments once you can when you have money, or do you put a lump sum into your mortgage? What can you do to ensure that perhaps even though the mortgage is expected to increase, you can actually be able to reduce the contribution?
I always tell people then, if you have money, rather use it for something. If you have money, rather use it for something, then putting the money in the mortgage. Remember, you are going already through challenges. Why don't you invest money into the business, into something which can bring a lot of money in order for you to pay in the near future? You get it? And another thing we must also remember is this. Think about it. You are going to take the money you have. If you have excess money which you have saved somewhere, for example, for emergency, for challenges, for political, for natural disasters, we have smart people who invest money like that to keep it just for such things. So if you're going through that, yeah, for example, if we are going through challenges like the time when the interest rate was just going up, it's better for you to pay more. You know, when you pay more, then you go to the bank and say, I need at least a payment period. For this particular period, I won't be paying my mortgage, so that at least I can accumulate money, because you have paid already. For example, you top up 100,000. So that 100,000 probably is for 6 months. So for the next 6 months, you have that grace period because you've paid already in advance. But you can also be smart and say, no, okay, I'll pay this amount in order to reduce my principal amount, because you're not going to reduce the interest rate. That's something you must remember. You will never reduce the interest rate, but you are going to reduce only the capital amount.
Okay, brilliant. Now let's talk about the advantages and disadvantages of refinancing to a different loan term or structure when interest rates are rising.
That is a structural method. What are the advantages of structural method? They are very good, because remember, when you are restructuring your loans, meaning now you are going to breathe a bit. In English, we say it's a breath. So you are going to have that period, a breathing period. So which means you're going to divert into a certain loan which can cover up, for example, your expenses for that particular time. But remember, whatever you put as an advantage for you, it's also a disadvantage, because you are doing a favor for the bank. You're not doing a favor to yourself, because the bank will always remain there, will still wait for their money. But you are just covering yourself for that particular emergency. But it's a disadvantage, because it will capture you in the future. It will capture you when the economy will start changing. You get it? So it's always you must always be five step ahead with the bank. You must always be smart that the bank will never make a loss. So you, as the owner of the bond or the loan, you must come up with strategy. Okay, for example, I have a bond. okay, this bond, I'm going to refinance it. Or this bond, I'm going to pay maybe, for example, 10% on that amount. So when you pay 10%, you're only reducing the capital amount. Yes, which is good. When you reduce the capital amount, which means as you are going towards, your installment is going to go down, which is an advantage to yourself. But now, when you prolong it, for example, refinancing, mostly refinancing is prolonging it. So which means it will catch you in the future. Remember, age are not remaining the same. You are getting old. You need at the end of the year, maybe at the end of 10 years or 20 years, to be owning your own house 100%, which your kids can also inherit or your family can inherit. You don't want to have some baggage which will carry you again in the future. Those are some of the disadvantages. For example, let's say like now what we are going through. Look at them. The economy was going through challenges at the beginning. The interest rate was going up and down. You get it. But now, America just hit us with tariff. Now look at, most of the things are very expensive now. Even with our interest rate which went down, I still don't see anything going to change, because remember, most of our things we depend from America.
Okay. Now, as we conclude our conversation this morning, let's talk about what is the best possible way to avoid taking on high interest debts, especially during periods of rising rates.
You see, you said it well at the beginning. You said financial discipline. We need to be financial discipline. And this week I wrote something. The banks are failing us. Yeah, our banks in Namibia are really failing us. These bankers, they are there just to give loans. They are not there to mentor people. If we give you a particular loan like this one, we give you a mortgage, it will affect you in the future. They don't even tell anyone about it. They just bomb you with a lot of loans. That's why you see majority of all the banks in Namibia currently, they made billion profit. But now let's look at it. We have high unemployment. Why is the bank not employing those people at least? Why is the bank not investing back in the community? Look at the government now have to come and bail us with the stadiums. But these things of facility like sport and infrastructures in our town, it's mostly supposed to be the business people to take. It's our responsibility, especially business people, to take that thing from the government and help them. I don't know any bank here currently in Namibia which own a stadium. But if you go to South Africa, other countries which have big population, they're investing like nobody's business. People talk about banks like our own bank, like Letseho. Let's say about Letseho. What do Letseho have in Namibia? Let's be honest to each other. What infrastructure do they have? What are they bringing? I'm not saying in a bad way. I'm just saying to all the banks. Standard Bank, what are they having? Is there any street which they say that this street was built by Standard Bank? Or is there any school they can say this school was built by Standard Bank? So those are some of the things which we need to look at. So as I cannot tell anyone currently that there's the best loan you can take. You can only take a loan once you are going through financial challenges. Once you are going through difficult, you can only take a loan when you know that there's no a door which you can open, but you are going to take this loan for a purpose to generate finance, not for the purpose to go and buy a bag or to go buy a car. You can buy those things. For example, if you know that there's a way on how you are going to generate money in order to pay those amount of money, I will never encourage anyone to take a loan, not even an overdraft. First of all, before you take a loan, let the bank explain to you what is the benefit of that loan, what are the disadvantage of that loan, who is benefiting, is it me or the bank? Because at the end of the day, remember, they give you have 5 loans. Let's give an example, 5 loans. With this current economy, anything can happen. You lose your job. Where are they going to put you? They'll put you on ITC. And when you go on ITC, you can't do anything in the world. You cannot buy a car. You cannot get a job, because even in the jobs, they'll ask you, can we see your ITC? So those are some of the things. We cannot encourage people to take loan. We can only encourage people to go and borrow once it's really in need, once they want to solve immediate problems.
Well, Jerry Chikambi, thank you so much. I think the message is clear. Do not borrow for personal consumption, whether for productive means, and that way, that is what you're suggesting. Thank you so much for making time to speak to us this morning.
Thank you very much, and I hope everyone outside there got the message. And guys, let's stay away from loans. Let's only use loans once it's really needed. So we can only move towards our success if we cut costs.
Indeed, I think the message is loud and clear. Thank you so much for making time to speak to us.
Thank you very much.
And now that was Jerry Chikambi, who's a director of Time, Money and Unity Capital, emphasizing that let's not borrow for personal consumption, but for productive consumption in it. And by all means, try to ensure that you do stay away from taking unnecessary loans and practice financial discipline.